Welcome back to the market right here on ET Now. Yes, a lot of these sectors will be in focus today, and especially the consumption basket will be in focus today on the back of that GST rate rationalization, but along with that, a whole host of other counters and individual counters will be in focus. So let's start taking that one by one with our guest as well. But before that, let me welcome Amnish Aggarwal on the show. Hi Amnish, good morning and good to be speaking with you. And Amnish, the first stock that I wanted to touch upon with you is actually Indus Towers. An interesting news flow coming in where the company has announced their foray into the international markets, wherein Bharti Airtel, they already have a presence. Now Indus Tower is saying that they are foraying into the African markets. But the other fact of the matter is, Amnish, that the company hasn't given or rewarded their shareholders since May 2022. There are concerns on that their exposure to Vodafone Idea and the kind of debt levels that they have. What is your understanding on this particular foray? What is your take on Indus Tower specifically?
You see, we don't have a clear view on Indus Towers as such. But having said that, when it comes to, you can say, foray in the international markets, yes, Africa is a good territory. The consumption levels there are less. For example, when it comes to data used in dollar, and Bharti has done, I would say, well over the past few quarters over there. So the foray over there will definitely be a boost in terms of increasing your geographical presence and the scope to earn more revenues and growth. But beyond that, I can't give you any definitive view because we don't have any, you can say, made-up numbers on this stock.
In fact, there's an interesting note from CLSA talking about as to how, while Indus Towers has planned this foray into the African market and it continues to be their high conviction outperform, but they're saying that Africa is not going to be significant. And while the dividend is awaited, and they are looking at how their fundraising activity is actually going to pan out. So they're saying Indus Towers' planned revenue diversification is unlikely to be significant despite the anchor customer relationship with Airtel Africa, and that they had expected the management to focus on improving Indus capital structure by paying out high dividend, though Indus's board is committed to the reinstatement of distributors, but with unjustified delay in dividends, they reiterate their high conviction outperform rating, though adjusting the target price from the earlier 595 to now 520. That's that on Indus Towers. But just looking at the telecom prospect, Chandan, read through the charts as well, both IndusInd, Vodafone and Bharti.
Yeah, so if you look at the telecom name, Bharti is always our preferred pick. However, it has been consolidating and a sense of buying is clearly visible. But if given the choice, I think Bharti could be one of the counter which is lower beta with margin of safety. But momentum will be seen only if the stock holds about 1940, 1950 kind of level. So as of now, the stock got stuck in a range between 1850 to 1950, and we are in the middle of the range. So we have to either play the range or look for a decisive breakout. Looking at the other name like Indus Star, negative price structure is clearly visible. It has given a fresh breakout from inverted pole and flake pattern. So I believe till it holds below 340, it can go down towards 310, 305 levels. So Bharti Airtel could be buy on decline, but Indus Tower looks weak as of now for further 3 to 5% kind of corrective move from current zone.
So that's a chart check coming in on Indus Towers and Bharti Airtel. Amnish, the biggest trigger for the market this week is going to be the GST meeting. Now, consumption as a sector overall is expected to benefit from the rate rationalization, both on the staples and the white goods front, given electronics like ACs, refrigerators, they are also expected to see a lower tax slab compared to where it is right now. So if you have to approach the consumption theme, would it be via staples that have been underperforming but have started to show some promise, or would it be on the discretionary end of it?
You see, as of now, there is very limited clarity we have on the tax slabs. What we know is that the 12% and 28% slabs are going to go away. Now, if we took it in a very simplistic manner, then most of the items which are at 12%, they will definitely move to 5%. And when you look at, say, those items in particular, you will notice that there are no, you can say, big companies, even in the staple space, which have got large majority of their, you can say, sales coming from these categories. Lot of consumption, or you can say staple segments, say for example, you look at say toothpaste, personal care, and many of these items, so they are at 18%. See, before this GST came in, earlier there were many items. For example, in biscuits, we used to have a bifurcation of price. That below 100 rupees per kg, the duty used to be less, and then on the premium, the duty used to be on the higher side. Now, if you look at the overall maths, then 18% tax slab is the biggest one, which contributes roughly around 65-70% to the total GST revenues, and 12% is not much. So to move goods from 12% to 5% should not be difficult. It can be managed very easily. But once you start moving goods from 18 to 5, then there could be, you can say, some issue. Now, how the government tackles it? Say, for example, you move from 18 to 5, there is very sharp reduction. Then obviously, you can say the companies are going to benefit out of it. Say, for example, you look at footwear, you look at apparel. There are certain goods which are at 5%, certain goods which are at 12%. Now, whether the 12 goes to 18, whether they change the limit. So there are, I would say, many intricacies which are involved over there. But having said that, if a lot of goods which are at 18%, they move to 5%, then some of the, you can say, companies, say, for example, which clearly will stand out to gain would be, say, companies like, say, Britannia will be there, Colgate will be there, HUL will be there. Say, for example, ITC acts of cigarettes, because cigarettes maybe you can say tax neutral, but otherwise it could be, one needs to see how they actually do it. So if there is no big change happening on the cigarette side, then ITC could also be a gainer both on the paper as well as on the staple front. So I would say if some of the items, big items which are at 18, they move to 5, then even some of the, you can say, large staple companies, they should be gainer out of it. Now, coming to second part of your question on the goods which are at 28%, particularly with regards to white goods, consumer durable, etc. I think there the reduction to your 18% looks very, very likely. Say, for example, you look at air conditioners, you look at some of the other items which are there. So I think some of these companies definitely they are going to gain. For example, lighting is at 12%, that could move to 5%. So I think a lot will depend upon how and in what manner it is done. Auto is another pack, where I think all the two-wheelers which are at 28% up to I think 325 cc is something which we are expecting should move to 18% very easily. Entry-level cars can move to 18%. So it depends upon to what you can say granularity the government goes and how they adjust it, but definitely the broader consumption basket is going to gain out of it.
Right. In fact, all eyes are going to be on the all-important GST meet, which kickstarts today and tomorrow as the Council takes a decision on the announcements made by Prime Minister Modi during his Independence Day speech. India is all set to move towards a simpler two-slab system, lowering rates on essentials and cutting GST on insurance to make health and term cover more affordable. In fact, my colleague Prakash is here to tell us more about what he's picking up and also what that EV taxation yesterday was all about that the wires were reporting.
Well, state for next generation GST reforms as the much-awaited two-day GST Council meeting begins today, where some significant announcements are expected. In fact, a complete overhaul of GST after 8 years of its implementation. GST geometric rationalization has already accepted the centre's proposal for two-rated structure, essentially 5% and 18%. A proposal of doing away with the 12% and 28% GST slabs has also been accepted by the GST GOM. A 40% slab will be created for thin goods and luxury items. 99% of items under 12% slab will come under 5%. Items under 28%, like cement and some other items, will come under 18%. Luxury cars, bikes, pan masala, tobacco to attract 40% GST. As per the proposal, GST on key economic sectors likely to come down. Sectors like agriculture, textile, fertilizer, renewable energy, automotive sectors, handicrafts, medical devices, insurance, construction could see big benefits under the new structure. However, state governments have raised concern about potential revenue loss. In fact, they have requested the government to come out with a clear framework supported by a mechanism to protect their revenue interest. In fact, they also want additional levy beyond 40%, especially on seen goods, to compensate their potential revenue losses. However, let's see how it pans out. Will there be a wider consensus on the proposal? But at this point of time, a very significant development coming in. The much awaited two-day GST Council meeting begins today.
Well, yes, all eyes will be on that as well, but we also have some bit of a news flow coming in on EVs as well, wherein Prakash also got us the news flow that the GOM on rate rationalization did propose a hike in the GST on the high-end EV cars from 5% to 18%. But along with that, the hike in the GST of the EV cars is not a part of the centre's government proposal for now, and this proposal is unlikely to be approved by the GST Council. Though the GST Council has to take the final calls, but for now it's not expected to be a part of the different discussions that are lined up. So definitely that is one of the key points with respect to the auto companies that will be in focus and how the GST on EVs really pans out to be. But on the back of this concern, Amnish, we have seen auto major M&M that saw a bit of a fall, because what we understand is that the company almost derived 10% of its revenue from the EV portfolio for now, but that's expected to inch higher. How are you analyzing this situation, and do you think that taxing EVs at a higher rate of those EVs which are above that 20 lakh bracket, is that a possibility, and will that be a rational move?
It is very difficult to say at this point of time, but having said that, there is a possibility. For example, you look at, say, SUVs or other cars, while the base rate is 28%, but then in case of your cars or SUVs which are above 4 meters, then the taxes are much higher. Now, if you look at, say, even EVs, today you are having EVs which are costing 40 lakh, 50 lakhs also. So there, I don't rule out that there could be, you can say, some attempt or some, you can say, some sort of a plan in the longer term to tax them at a higher rate than just 5%, so that can't be ruled out, because in case of petrol and diesel, you are taxing those vehicles at 45%, 50% also. Now, whether it will happen now, whether it will happen in future is something which we have to, you can say, wait. Very difficult to say it will happen now, but something I think in the longer term, I think it can't be ruled out for sure.
Okay. A lot of stocks that we need to keep our eye on. There's Indus Towers that we talked about. There's Foray Energies. They're looking to buy 64% of Cotsons for a total consideration of 192 crore rupees. There's Yes Bank, which has got a CCI approval for SMBC, buying that near about 25% stake in the bank. TCM Shriram, also some of these white good companies, and in particular the refrigeration or AC stocks. Stricter energy efficiency norms are going to kick in for ACs come January 2028. So while there was that fillip that you saw post the buzz around GST, that also got sold into in yesterday's trading session, or perhaps today that weakness could trickle in. For JSW Cement, the Q1 top line is looking weak on a sequential basis on the back of lower realizations. This relatively newer listed entity, look out for what this does. And then, of course, we've been talking about TCS, Moil and Eternal, which has also hiked its platform fee just ahead of the festive season. But Chandan, just looking at banks in particular, given the weightage and given the fall that you had in the entire segment yesterday, would you be tempted to short any of the private banks further today?
So looking at the banks, I think Bank Nifty itself looks weak. The way it fell to hold above 54,000, 54,150 and drifted below 53,750 or even 53,600, it can go down. So in Bank Nifty, either we can go with buying put or can sell with hurdle at 54,000 for the downside. Target was 53,252, 53,000. Now looking at the stock specific, I believe slightly negative to range bound bias could be seen here. Kotak Bank will be one counter, which is comparatively weak, or any small bounce is being sold. So as of now, with hurdle at 1985, it can go down towards 1900 marks. ICICI Bank is one counter which has been moving in a negative to range bound bias with slightly lower top, lower bottom. But one need to keep in mind that we are not expecting major decline, but some profit booking cannot be ruled out here. And if you ask me one positive name in the banking, that will be RBL Bank, one of the strongest counter, which is forming the rounding formation on the monthly chart with support of 261. It can head towards 280 kind of level. So RBL Bank is the only name which is strong. Otherwise, ICICI Bank, Kotak Bank, or counter like Indus Bank could be under pressure.
Okay, so that's the pecking order coming in from Chandan on his preferences in the private banking space. Chandan, thanks so much for your time. Appreciate you joining us this morning. But Amnish, while we are talking about the entire banking and financial space, and we've just highlighted the private banking space, what are you making of PSU banks? Because we're seeing mixed performance coming in, but they're managing to hold up or do pretty okay for themselves. What's your take on the PSU banks and which stocks are you liking from this basket?
PSU 1Q as such was not great for, if you look at the entire banking space, barring couple of names, and PSUs, I think they were, I would say, in certain pockets they did slightly better because their exposure to MFI or some of the unsecured segment was slightly on the low side. Now going forward, I believe that the entire banking space from the second half of the year should gain a bit because you have got the benefit of your liability repricing also coming in, which obviously, first of all, impacted PSUs less than private banks because the linkages there are slightly different. But having said that, I think at the current juncture, if you look at the PSU basket, I think SBI, which is I think the largest bank in the country, so SBI is something which looks reasonably good to us at the current juncture in terms of the valuations, in terms of, you can say, other things. So I think PSUs also, they can give you, I would say, reasonably good returns. SBI is I would say, the top stock in that bracket. But banking overall, I think over the next 6 months or so looks reasonably good and obviously led by the likes of your ICICI Bank or HDFC Bank.
Right. We've got Rajesh Palvia as well joining in on the show right now. But Amnish, just wanted to speak on IT. Does it seem like the sector could have bottomed out in terms of negative news flow? Because if you analyze the news flow of late, a couple of strategic announcements coming in. TCS, for instance, is now expanding its partnership with European insurer, Trig as well. They've signed that $550 million deal too. Do you think all the uncertainties are now evaporating for IT? And could now one look at it at least nibble in, if not go all in into IT?
See, we are not that positive on IT. Yes, I agree that in terms of valuation, the sector is now in a much better shape than it was, and the valuations are very supportive. But having said that, in terms of the visibility of growth, it is still not there. You see, some deals might be announced here or there, but the structural issues with regards to slowdown in, you can say, Europe, potential problems in US, and then you are having this entire AI thing, which is now coming into in a very major way. So the growth rates are very uncertain. Most of the companies are still not growing. Yes, in terms of valuation, they are, I would say, at the near bottom. The dividend deals are attractive. But having said that, I think, yes, one can, you can say, nibble at the stock. But if you ask me whether one can take a 1 year, 2 year call over there of something very structural where you can make very, you can say, decent amount of money, I think it doesn't seem to be in that bracket to me at least.
All right, so that's the take coming in on the IT space. But Rajesh, first of all, very good morning. And Rajesh, there's a lot of sector churning that is still underway. Last week was all about autos and consumption, but just yesterday and the past 2 weeks, we are seeing that some of these PSU counters are now making a comeback. Add to that list to select metal counters, select IT names. So firstly, help us understand that sectorally, where are you placing your bets and how are you seeing that sector churning that is underway?
Good morning, Swasti. Good morning, everyone. So if we look at the positive sector at this moment, consumer durable, FMCG, automobile, these sectors are clearly, and new age stocks, these sectors are clearly in uptrend from the technical perspective, and consistent buying is happening in this sector. Now looking at the churning in the sector, so some of the buying interest has been visible in metal space as well as power space is also showing sign of some buying interest from this in this corrective move. So I think these all sectors can be looked at for near-term to short-term perspective. Moving to the PSU space, some of the railway stocks have witnessed buying interest in the previous day. RVNL has shown good traction in terms of buying action. Some of the metal stocks are also, showing a sign of buying interest. So stock like NMDC, SAIL are showing traction from metal space. RVNL is looking attractive. So I think this new, buying interest in moving in this sectors where, we have seen already oversold trajectory. So I think one can focus on all these stocks for near-term to short-term perspective. But for clearly in uptrend, FMCG, consumer durable, automobile, these sectors are clearly in uptrend. So I think here is opportunity for trading perspective in the near term as well as for the short term.
Right, so those are some sectors that are looking good to Rajesh. Amnish, want to get your sense on the entire chemical space because yesterday we've received news flow that there's some relief to chemical exporters wherein the government has extended export obligation period from the existing 6 months to 18 months. Now this move is poised to simplify trade processes and elevate the global market edge of Indian goods is what we understand. So certain names like SRF, Naveen, RT Industries, they could stand to gain. But overall, how are you reading into this space right now?
You see, chemical stocks have come up the highs. That is one reality which we have to look at. The second is we also need to look at that in addition to the domestic demand, many of these companies, they are big exporters. And India actually, I think there's some $2.5 billion of chemicals which actually go to US also. So how will these companies cope with the 50% duty is something which is not clear to us at this point of time. But yes, some of these stocks, say for example, many of the stocks may be 25, 30, 40% down from the peak. So you can say selectively look at some of these chemical stocks with I would say, because the valuations have become supportive in many of these names. But having said that, one needs to be, you can say, pretty clear of the uncertainties which can come because the companies which are having more US exposure in terms of exports, so there could be some bumps here and there coming from such companies.
Right, okay, that's the take coming in on some of the chemical plays right now. Just looking at what else is happening in the market while we are awaiting the pre-open rates, you've got the GIFT Nifty just mildly soft right now. The next 2 days, of course, extremely critical for the markets, given that the GST meeting, the 2-day GST meeting is going to kickstart today. It still seems pretty much a deadlock on tariffs, at least with the US. While negotiations may be on, at least the positioning or the narrative from Donald Trump doesn't seem to be indicating that he is willing to bow down. But that said, the global markets as well, the global bond yields definitely are a little bit of a concern, given that the spike that you're seeing at a time when most central banks are in easing mode is a little bit of a confusing signal. But yeah, that's the implied open right now. 24,640 is where we're currently at. Yesterday also it turned out to be a little bit of, once again, that range-bound kind of trade day for us. Though we closed in at the session lows thereabouts, weighed in heavy by banks. They were the ones which really were the draggers. 24,691 is where we shut shop for the Nifty futures. And yesterday, names like Samman Capital, RVNL, NMDC, Dabur, Nalco, these were the ones which were the most buoyant from within the broader end of the market. And of course, on the flip side, other than banks, there was also M&M. As soon as news reports came out that perhaps the taxation in the GST rejig for EVs over 20 lakh rupee units is going to be a lot more. M&M took a hard fall of about almost 2.25% or so. But Amnish, what's the sense right now on the market? You think one should really be in wait and watch mode or put fresh capital to work, given that that market is range bound right now and the positive triggers haven't yet come in?
This market currently is reflecting some sort of very indecisive situation because on one hand you are facing with the impact of likely tariffs, and approximately $65 billion worth of Indian exports to US. They are at some or the other type of risk over there. So that is one part of it. On the other hand, we have got a very, very good macros currently in terms of inflation numbers, in terms of, you can say the monsoon has been pretty good, although there have been floods in several parts of the country. And there have been, for example, tax cuts have been there, now GST reduction is likely. So all these macro, you can say, initiatives are good, and given the fact that there are external pressures, so there is likely to be more, you can say, initiatives by the government to push the domestic demand and push the economy and reach out to other countries to push the exports. So to that extent, I think the markets are very, very well poised at the current juncture, and it is actually waiting for a trigger to happen. Which people are expecting that the festive season demand should be a trigger coupled with the GST. So very difficult to say about, say, next 20 days or 30 days where the things are headed, but definitely if you are taking, you can say next 6 months or a 1 year view, I think the markets are very, very decently poised at the current juncture, and one should accumulate fundamentally strong stocks at this point of time.
Okay, so that's the take on what the investment approach or trading approach should be in the market right now. One stock in focus is going to be Eternal, because they have hiked their platform fee from 10 rupees earlier to 12 rupees now. This is per order, and this is being done for the festive season. Now remember, this follows Swiggy's platform fee hike from 10 to 12 and now to 14, and this announcement came in 2 weeks ago. While this may look incrementally positive for the stock, Elara believes that this would not lead to too much of a positive for the stock, and here's why. Because in terms of a financial impact, if you take a look at the Q1 numbers, Zomato's food delivery EBITDA margins were higher by 180 bips compared to Swiggy's at 4.2%. Now, for each rupee of a platform fee hike that Zomato undertakes, Zomato has a 22 bips positive impact coming in on the take rates, while the positive impact on the adjusted EBITDA is just 110 crore rupees. It's not a significant gap up over there. The move will accelerate the company's target to hit that 5% adjusted EBITDA margin guidance that they have maintained, and the hike is likely to be implemented to only 40% of the market initially. Thus, Elara expects that the FY26 impact of this hike at least should be modest at best. They say that Zomato's food estimates are pricing in the adjusted EBITDA margin of 120 bips to 5.1 and take rates at 200 bips to 21.9% over the course of FY25 to 28. So on the back of all of this math and calculations, they are saying that unless they hike the target price to 14 rupees, which is where Swiggy's platform fee is right now. So if they hike that platform fee to 14 rupees, only then could the company's financials see a major positive fillip from this move. Otherwise, this 12 rupee figure that they have come to for the platform fee is not expected to do much for the company. So at least that is the word coming in from Elara. Rajesh, we've spoken about Eternal earlier on the show, but let's talk about its biggest competitor, and let's talk about Swiggy right now, because Elara also continues to be positive on Swiggy. Do you share that view as well, and how is Swiggy shaping up on the charts?
So Swiggy is also showing a sign of buying action, and the way stock is moving in upsloping channel on weekly chart, it clearly indicates that there is a sustained buying action is taking place in this counter. Since the stock managed to give breakout above 410, I think if it continues to above 410, possible up move towards 445, 450, we may see in the near term to short term perspective. So both Eternal and Swiggy both are looking attractive for near term as well as for the short term, and I think one can deploy a long trade in both the counter for near term upward momentum.
All right, so that's the take coming in on Swiggy as well as Eternal. But along with that, Rajesh, also help us with your mid-cap bets for today.
So two stock idea both on the buying side. First one is from the power space, that is CG Power. Very strong breakout of a consolidation range of almost 8 to 12 week. Looking at the breakout and the data setup, we believe that this momentum can extend further. We are projecting target of 770 for CG Power. There is a long built up in derivative data. So looking at the data setup, we are holding bullish view. On the downside, one can place a stop loss towards 724. Another stock is again from the consumption theme, and Bata India is looking attractive. after a long corrective move, stock now is showing sign of reversal. There is a breakout on weekly chart of falling trend line. Looking at this breakout, we believe that there is a trend reversal in this counter, and we could see furthermore upward trajectory for the counter. Possible target for Bata, we are projecting around 1190. Keep stop loss around 1125 to buy Bata India.
Okay, let's tell you what else has been happening around the world. But Amnish, we'll let you go before that. Thanks as always for joining in and for your time.
Thanks.